Gold and silver hold your purchasing power intact and protect you. And they are the bridge to get you from one system to the other system. And also, oh, by the way, take advantage of opportunities along the way as all of this fiat money inflation is burned out of these assets. And again, we see who's going to survive.
Every day, gold and silver prices rise, fall, and at times fluctuate with such volatility that they grab front-page headlines. A stronger than expected jobs report sends gold prices lower. A geopolitical flare-up sends them soaring. Silver rallies 4% in a single day, only to subsequently give back half of its gains. If you check prices daily, it can feel as though you are enduring a genuine financial shock. The natural reaction then is to act, to sell before prices fall even further, to wait for a better entry point, or to question whether the investment thesis you held just a month ago remains valid. This impulse is understandable. However, it is precisely this impulse that leads most investors to throw in the towel before substantial gains have even had a chance to materialize. The investors who reap the greatest rewards from precious metals are not those who react to every headline, but rather those who know how to distinguish the signal from the noise. According to Lynette Zang, you have a great chance to become rich with gold and silver. Before we move forward, if you want to stay up to date with the latest gold and silver news, you can subscribe to our channel and like this video. Now let's get back to Lynette Zang's view on gold, silver, and the overall global economy.
Public is really hesitant, and they're also not comfortable with their job prospects, either maintaining their position or losing their position. And so that has everything to do with confidence in the system. And that is required because this is a Ponzi scheme. And so there are two key things that are always required in every Ponzi scheme. And this is what the problem is. The biggest one is confidence. And the second one is new money. And we've kind of already done that new money piece so that when they go out and they being the central banks, when they print and create from debt all of this new money, it destroys the rest of the purchasing power. So now when you go to the store and that loaf of bread has gone from, $5 for a loaf to $9 for a loaf, what does that do to the confidence that you've got some kind of stable future? And there's already a growing revolution, which thank goodness, because there needs to be. So I see inflation probably back at 7-8% officially, which means much higher than that unofficially. When you study currency life cycles and you see these repeatable patterns, and to your point, Jesse, they are not going to just go, oh, all right, we've taken enough from you. We are going back. If we don't do something about it, if we don't get redeemable gold back in the system again, we're back at feudal times. Because this digital prison, I've been watching Bitcoin since what? It came out in 2009. I believe it was 2010 at $7 a coin. That's how long I've been watching Bitcoin. People think I don't know anything about it, but, and you're right. I'm not an engineer, and I'm certainly not that kind of an engineer, but I absolutely trust my knowledge on regime changes and currency life cycles. And people will stop. They're going to stop all discretionary spending. They don't have any choice. They already don't have much choice about that. And then if they do, what does that do to all of the prices? It makes them go up even more. That's that doom loop that goes from, collateral, intermediary, liquidity, confidence, and then real world.
If you are looking for proof that volatility does not invalidate a long-term bull market, look to the 1970s. Between 1971, when the United States closed the gold window, and 1980, the price of gold skyrocketed from $35 per ounce to over $800. Silver, for its part, surged from around $1.50 to nearly $50. On paper, this looks like a straight line ascent. However, annual returns paint a very different picture. Gold posted solid gains in most years, But 1975 and 1976 were difficult times, a cumulative decline, which occurred following a massive rally that likely drove many investors out of the market who had bought near the 1974 peak. The reward for those who held firm came later, a 133% gain in a single year in 1979. Silver proved to be even more unforgiving. It began the decade with 2 consecutive years of declines, spent 1975 in the red, and then generated a staggering 434% return in 1979 alone, before giving back a significant portion of those gains in 1980. Investors who threw in the towel during one of these corrections didn't just miss out on a modest rebound, they missed the entire winning streak. Imagine having to endure 2 negative years at the start of the decade, watching prices stagnate and telling yourself that you were wrong, only to finally see silver execute one of the most explosive annual rallies in commodities history. This is the toll that short-term noise exacts on long-term investors. Yet, the structural signal throughout the decade was clear: inflation, currency, depreciation, and an erosion of confidence in the monetary system. The volatility was indeed real, but it by no means constituted the whole story. Investors who remained focused on underlying fundamentals were rewarded. Those who allowed this noise to dictate their decisions were driven out of the market before the most significant gains materialized. Gold and silver have always been volatile. This is not a flaw. It is the very nature of assets that exist outside the financial system and that react to forces that most investors spend years ignoring. Daily noise will always be present. Fed announcements, employment figures, geopolitical headlines, none of this alters the structural context. Although gold has recently posted a lackluster performance, its importance as a portfolio diversification tool has only increased, particularly as correlations among various asset classes intensify. Contrary to expectations that rising geopolitical tensions would boost gold prices, the metal actually experienced a 15% decline during the month of March. The strength of the U.S. dollar proved to be a significant headwind, deterring buyers outside the United States, while expectations of interest rate hikes made holding non-yielding assets such as gold less attractive. Nevertheless, the analysts highlighted that gold had successfully withstood similar pressures related to the dollar and interest rates in 2022, thereby defying traditional assumptions regarding its behavior. Lynette Zang forecast a potential resurgence of inflation and urges investors to consider gold as a crucial hedge against impending financial turbulence. Mrs. Zang has repeatedly warned of the dangers of fiat currencies and emphasized the importance of sound money principles. She believes that this year, we will witness much higher inflation and that it will materialize far more rapidly, Zhang stated, highlighting the disconnect between the Federal Reserve's monetary policies and the reality of rising prices. That's all for today. Let us know your views in the comment section below, and don't forget to like this video before leaving. Thanks for watching.